Hello, it's time for What Would Peter Lynch Do? It's May 30th. And as tariff concerns rise again, the stock market closed slightly lower today. But Costco did well. And that actually leads right into our listener question for today. Someone asked, Costco is up again. How do you analyze the retail industry? So our mission for this deep dive is to explore Peter Lynch's wisdom on analyzing retail companies and also understanding those corporate performance announcements. Using this question as our starting point, we'll be drawing insights, directly from the source material we have.
Yeah, that's a fantastic question to kick things off. Peter Lynch, he had this really unique perspective on retail. It was a mix of intuition and some pretty serious analysis. He famously said, if you like the store, chances are you'll love the stock.
I love that. It feels so, intuitive, right? Like if you actually enjoy shopping somewhere, if the place is always busy, people are talking about it, that's kind of your first clue, your own gut feeling as a customer.
Absolutely. Your own experience, that's the starting filter. But Lynch definitely didn't stop there. He wasn't just saying, oh, buy whatever store you happen to like. No, he really pushed you to look deeper, beyond just the crowds and the products you like. One of his really critical points was about something kind of hidden from view. Inventories.
Inventories. Why inventories? Why did Peter Lynch focus so much on, stock levels for retailers?
Well, he saw it as a potential major warning sign. He actually said, whenever I'm evaluating a retail enterprise, in addition to the factors we've already discussed, I always try to look at inventories. And the reason, he followed up with, when inventories increase beyond normal levels, it is a warning sign that management may be trying to cover up the problem of poor sales.
Wow, okay. So it's not just some number on a spreadsheet. It could be a signal that something's, wrong underneath. Goods piling up means customers aren't buying as much.
Exactly right. And that unsold inventory, it costs money to store, it might go out of style or expire, lose value, and eventually the company probably has to mark it down heavily, which just eats away at their profits. It's like a blockage in the system.
Okay, that makes sense. What else did he look for beyond just checking the inventory situation?
Growth potential.
Yeah.
That was huge for Peter Lynch. He wanted to know if a company's success in one place could actually be repeated elsewhere. He really stressed looking at their ability to expand. He said, one of the first things you need to know about a retail operation is whether it can afford to expand. Basically, can they take that winning formula and roll it out? Do they have the money, the operational strength to grow bigger without tripping over themselves?
So, okay, start with the vibe, the customer experience, but then immediately pivot to the hard stuff, inventory health, and whether they can actually grow sustainably. That feels like a much sturdier way to look at a retail stock.
It really does. And before we get too deep into applying all this, let's just quickly paint the picture of what we mean by retail sector. At its heart, it's businesses selling stuff directly to, you, the consumer.
Right, like department stores, supermarkets, your local convenience store, big online players, clothing brands, grocery stores. It's a huge category.
Exactly. You've got the global giants like Walmart, Costco, Target, Amazon, Home Depot. And then, depending where you are, local leaders like, say, E-Mart or Coupang or Lotte Mart in Korea. It's a massive slice of the economy. And as our sources really emphasize, the number one driver, the absolute key variable for this whole industry is simple. How much are people spending? Consumer confidence and spending power dictate everything here.
Which leads us nicely into the unique characteristics of retail, right? What makes it kind of tricky or different for investors? You mentioned how sensitive it is to the economy overall. Oh, highly sensitive, yeah.
Right.
Consumer purchasing power is key. When the economy's humming along, people feel secure, they spend more freely. But when things get tight, spending pulls back. And usually it's the non-essentials, the luxury goods, the higher-priced items. They feel the pinch first.
And it always feels like trends change so fast in retail. What's hot today might be totally out tomorrow.
Absolutely. That's consumer trend sensitivity. Retailers have got to be incredibly nimble. They need to adapt super quickly to shifts in taste, fashion, and maybe, most importantly now, how people shop. The move to online, mobile shopping, different delivery expectations. If you fall behind on those trends, you lose your edge fast.
And the competition just seems constant. Everywhere you look, there's another option.
It's fierce.
Yeah.
The barriers to actually start a retail business can be lower than in some other sectors, so you end up with this intense fight over price, service, and definitely the online experience now.
Okay, so adapting, competing, those are huge. And we touched on it, but that importance of inventory management seems central. It really is foundational. Because they're buying and selling actual physical goods, getting that inventory level right is absolutely critical. Too much is costly. Too little means lost sales. It's a real balancing act.
I also think about just how much advertising we see. Marketing and brand power must be incredibly important too.
Oh, totally. It's a key way to stand out. Building a strong brand that people recognize and trust, running campaigns that actually work, that's crucial for getting people to choose you over the competition, sometimes even if the price isn't the absolute lowest.
And for some types of retail, there's definitely seasonality.
Right. Winter coats sell in winter, swimsuits in summer, lots of gifts around the holidays. Companies selling those kinds of goods see big swings in their sales depending on the time of year. Investors need to understand those natural cycles.
Okay, so we've got a handle on the sector's quirks. Now let's get practical. Beyond the usual stuff like total revenue and profit, what are the specific things Peter Lynch, or just a smart investor, would really zero in on to evaluate a retail stock?
Right. You need metrics that cut through the noise and tell you how well they're actually managing those challenges we just talked about. And the first one, related to sales, isn't just looking at the overall sales growth number.
Because that can be boosted just by opening more stores, right? Doesn't tell you if the existing stores are doing any better.
Exactly. So Lynch and, frankly, most savvy retail analysts focus heavily on same-store sales growth, or sometimes it's called comparable store sales. This looks only at sales from stores that have been open for, say, at least a year. It filters out the growth that just comes from expansion. It's the real measure of whether the core business is healthy and gaining traction with customers.
That makes way more sense. It's a much cleaner number. What about profitability? Are there specific margins to watch?
Yeah, definitely. You look at gross profit margin that tells you how efficiently they're buying their goods and pricing them. Then operating profit margin, which shows the profitability of the main business operations before interest and taxes kick in. And finally, net profit margin, which is the actual bottom line profit left over. Watching the trend in these margins is really key. Are they holding up, improving, or getting squeezed by competition or costs?
And circling back to that inventory point, is there a specific number to track how well they manage it?
Yes, absolutely. It's the inventory turnover ratio. Basically, it measures how quickly a company sells through its inventory and has to restock it. A higher turnover ratio is generally good. It means stuff is flying off the shelves, inventory is fresh, and management is sufficient. A low, or worse, a declining turnover ratio can be that big red flag Lynch talked about.
Okay. What about cash? Is profit enough or is cash flow different?
Cash flow is critical. Specifically, operating cash flow. A company might report growing sales, maybe even profit, but if they aren't generating actual cash from their operations, that's a problem. It could mean maybe they aren't collecting payments from customers effectively, or maybe all that profit is tied up in, guess what, growing inventory. You want to see healthy cash coming in the door from the day-to-day business.
And with shopping changing so much, I assume looking at their online channel growth and strategy is just table stakes now?
Oh, completely non-negotiable. Investors have to look at what percentage of sales are coming from online, how good their website and app are, and their whole omni-channel approach, how smoothly they connect the online and physical store experiences. Are they actually competing effectively in the digital world?
How do you measure something fuzzier, like customer loyalty and brand awareness?
It's trickier, but you can look at metrics like the number of loyalty program members, how often people repurchase, maybe customer satisfaction surveys, brand perception studies. It gives you a sense of whether customers are sticking around for reasons beyond just price.
And for the brick and mortar side, the actual stores.
A classic metric is sales per square foot. It helps you gauge how productive their physical space is. Are they getting enough bang for their buck from their real estate?
And last but not least, you always have to look at the competition.
Always. Competition analysis means understanding their market share, how their prices compare, and crucially, what their strategy is for being different. What makes them stand out in that crowded field? Do they have a real edge?
Okay, that's a really solid set of tools for looking inside a retail business. So, armed with all that, what are the big picture things an investor really needs to think about before putting money into a retail stock?
Well, first off, you absolutely have to monitor macroeconomic indicators, things like consumer confidence surveys, job numbers, interest rate movements, inflation. These directly impact people's willingness and ability to spend. A sharp rise in interest rates, for instance, can really dampen enthusiasm.
And that trend sensitivity we mentioned earlier, that it sounds like you need to constantly reassess if the company is keeping up.
Constantly. You have to evaluate their sensitivity and adaptability to trend changes. Can they pivot? Are they embracing things like, say, sustainable products, if that's what consumers want, or new ways of selling like subscription models or live video shopping? Companies that get stuck in their old ways can decline really, really quickly in retail.
Finding that sustainable edge seems like the holy grail in such a competitive sector.
It really is. You have to actively identify sustainable competitive advantage. Don't just be drawn in by low prices today. Look for something more durable. Do they have unique products nobody else sells? Exclusive brands people love? A truly superior online platform? Maybe unbeatable logistics? And Peter Lynch would definitely look for companies that have the power to raise prices sometimes. That often comes from real brand strength. People trust them or desire their products enough to pay a bit more.
So like you said, a real reason people seek that specific company out, not just the cheapest one on the block.
Exactly that. And back to fundamentals. Always evaluate their inventory management ability. Steer clear of companies where inventory keeps ballooning or turnover is consistently poor. It signals operational weakness.
Checking the debt levels too, I assume.
Crucial. Check debt levels. A retailer carrying a lot of debt can become very vulnerable if there's an economic downturn and sales slow down. It reduces their flexibility.
What about technology? Is that becoming more important?
Oh, definitely. Seeing active technology adoption and innovation is usually a positive sign. Are they using data analytics to personalize offers? AI to forecast demand better? Automation in their warehouses? Tech can be a major driver of efficiency and a better customer experience now.
And sometimes rules and regulations can play a role.
Sure. You need to consider potential policy changes. For example, in retail, which often has a lot of employees, a significant minimum wage increase could directly impact profitability, so you need to factor that in.
So the big takeaway is, it's definitely not just about walking into a store you like and hitting buy on the stock. You really have to roll up your sleeves. Look past the name you know.
Precisely. Do the homework. Analyze the numbers, understand the strategy, figure out the real competitive advantage, and keep the big economic picture in mind. Ask yourself those key questions. Is there a reason people specifically seek out this company? And maybe just as important, is it structured to withstand a recession?
Those are really powerful framing questions. Okay, let's use this framework now and circle back to that listener's question about Costco, especially thinking about that market context we mentioned, the sort of post-tariff war period.
Right, that context is really interesting. The tariff situation starting around 2018, it injected a lot of uncertainty, didn't it? Suddenly, those reliable, cheap goods from China faced potential price hikes, maybe even questions about quality consistency. And what happened? Consumers started prioritizing verified quality and reliable supply, but still at a reasonable price. That whole environment really played into the hands of retailers focused on delivering value and, importantly, trust.
And that included both Walmart and Costco, right? But maybe in different ways?
Yes, exactly. Walmart, with its huge store network and relentless focus on low prices, they definitely saw a benefit as consumers looked for cheaper options on, well, everything. They're strong in groceries, basic apparel, electronics, but Walmart's model is very margin-driven. When price competition heats up or costs rise, their margins feel that pressure directly. And maybe, just maybe, their brand doesn't scream trustworthy quality in quite the same way Costco's perceived value proposition does.
Okay, so how did Costco navigate that period differently? What was their edge?
Well, Costco's whole business model is different, built around that membership fee. That fee changes the dynamic. It's not just revenue. It creates an upfront commitment from the customer. And with that comes an expectation of trust. I pay you this fee. I trust you to deliver quality and value consistently.
And they managed to deliver on that promise during that uncertain time.
They really did, and
Yeah.
that was key. Their reputation for strong quality control, the reliability associated with their products, especially their own Kirkland Signature brand, which has a huge following, became major assets. And crucially, their supply chain control was a big factor. They have strong, direct relationships with suppliers. They buy in massive bulk. They have efficient logistics. All this helped them manage disruptions better than many others. They were better positioned to minimize price increases and keep quality consistent when other supply chains were shaky.
Okay. So maybe Walmart's advantage was partly being the go-to, cheap, accessible option when wallets felt tight, perhaps more of a short-term price-focused benefit.
Exactly. Whereas Costco's advantage stemmed from being seen as the reliable, trustworthy source for good quality products at a fair price, even when things felt uncertain. It was more structural, more trust-based. And in a time of uncertainty about both price and quality, that trust became incredibly valuable.
That really clicks. It explains why Costco's performance felt so strong beyond just sales numbers. It wasn't just volume, was it?
No, not at all. Sure, sales were strong, but you also saw their membership numbers growing. And critically, those incredibly high renewal rates staying put consistently over 90% in the US and Canada. That high renewal rate is a powerful signal of enduring loyalty and trust. For many members, Costco isn't just a store. It's perceived as like a reliable part of their life infrastructure. They really emerged as a prime example of a trust-based consumption model during that period.
And that's the deeper story behind the stock price movement. It's not just sales rep. It's about understanding their unique model, their supply chain strength, and how that resonated perfectly with a shift in consumer behavior driven by external events like the tariff uncertainty.
Precisely. It perfectly illustrates why applying Peter Lynch's approach is so valuable. You have to look beyond the surface, scrutinize the operational details like inventory and supply chain, understand the business model's nuances, and really weigh those qualitative factors like trust and competitive advantage. That's how you truly grasp why a retailer thrives, especially when the environment gets challenging.
So wrapping this all up, investing successfully in the retail sector clearly requires more than just liking the store. It means really digging into its unique dynamics, using those key metrics like same-store sales and inventory turnover as your tools, assessing if they have a genuine, lasting competitive advantage, and understanding just how critical things like adaptability and, as we saw with Costco, consumer trust can be, especially when the economic winds shift.
And I'll say a word from Peter Lynch today, and I say that this principle is connected to not only investment decisions, but also life wisdom.
That's a great point. Think about that idea of trust-based consumption, or asking, is there a specific reason people seek this out?
Oh.
How could that apply beyond just stocks, maybe in relationships, or how you build your own reputation? What truly makes something or someone uniquely trustworthy and valuable? Definitely something to mull over.
Indeed. Food for thought.
I'll see you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.